Welcome to vTalkInsight, Risk Sentiment Daily for April 7th, 2026. Oil prices, war headlines, and an AI-driven capital cycle are pulling risk appetite in opposite directions today. Let's look at how that tug of war is shaping risk sentiment across equities, credit, and rates. Risk sentiment today looks cautiously risk-on rather than outright defensive. U.S. equities are modestly higher and volatility, while still elevated in the mid-20s, is off the recent spike seen during earlier phases of the conflict. Under the surface, credit spreads remain contained and capital markets are open, with strong demand for new corporate bond deals and ongoing activity in the IPO and M&A pipelines. That backdrop signals that many allocators are still willing to supply risk capital, even as they stay alert to geopolitical shocks. The push toward risk-taking comes from resilient U.S. earnings, especially in technology and AI-linked areas, as well as structurally attractive yields in high-quality credit. At the same time, a powerful pull toward caution comes from the Middle East energy shock, rising inflation prints, and long-end yields breaking above prior resistance. This leaves positioning balanced but nervous. There is no sign of broad capitulation, yet hedging activity, sector rotations, and a clear preference for resilience over cyclicality show how dependent this fragile risk-on tone is on the next inflation data and the evolution of the conflict. AI investment and earnings resilience remain one of the strongest supports for risk appetite. Across hardware, software, and infrastructure, demand linked to large language models and data-intensive workloads is creating a multi-year capital cycle. Evidence ranges from memory chip producers experiencing a supercycle with component shortages and rising prices, to Foxconn reporting a surge in sales tied to AI hardware demand. Analysts are upgrading names like Seagate and Western Digital on the back of clearer pricing visibility and structural tailwinds through January 1, 2027. On the platform side, companies such as Microsoft are trading at rich multiples, yet projected free cash flow growth in the mid to high teens is seen as achievable if AI adoption accelerates. Cybersecurity budgets are expected to double as a share of IT spend over the next few years, and Oracle is committing tens of billions to AI-focused data centers. Demand is also reshaping private markets, with large firms like SpaceX and OpenAI expected to tap public equity as their capital needs outgrow private funding. That suggests AI is not just a tech story, but a market-wide investment theme capable of absorbing substantial liquidity. For portfolios, this AI-driven growth offers a powerful earnings anchor that helps explain why U.S. equities have been relatively resilient despite war and an oil shock. However, the leadership is narrow and valuations in some mega caps are already demanding, while consumer and cyclical sectors face softer demand and higher input costs. Markets are starting to differentiate more sharply between perceived AI winners and everyone else, which increases dispersion and stock selection risk. The key watch point is whether the current wave of AI-related spending translates into sustained profitability across the ecosystem, or whether macro headwinds and higher rates eventually slow the cycle. Robust capital markets and credit conditions are another important bullish driver. Corporate bond issuance is running at record levels, with strong demand from investors sitting on roughly several $1 trillion in money market funds seeking better yields. Investment-grade yields around 5% are seen as historically attractive, and fundamentals in both U.S. and European credit remain solid, with low default rates supporting appetite for investment-grade and select high-yield deals. That stability in spreads, despite geopolitical noise, helps contain broader risk premiums. Equity capital markets are equally active. M&A volumes just delivered a record first quarter as companies took advantage of regulatory tailwinds and pockets of market calm to accelerate deal-making and public offerings. The expectation of a mega IPO from SpaceX, alongside potential listings from other large private AI names, signals that issuers view conditions as good enough to come to market. That perception of liquidity and risk appetite can be self-reinforcing, at least while financing costs remain manageable. This positive picture is not without cracks. Parts of the private credit complex are facing mounting redemption requests, stricter withdrawal limits, and concerns around opaque valuations, leading to nervousness about potential losses in a downturn even if systemic risk looks contained. If higher inflation pushes long-term yields further up, refinancing costs for weaker borrowers could rise sharply and eventually widen spreads from today's tight levels. For now, though, the combination of healthy corporate balance sheets, still solid earnings, and eager demand for new issuance continues to act as a powerful cushion under risk assets. Equity resilience and supportive positioning are keeping the broader tape from breaking, even as stress builds underneath. Despite a sharp rise in oil and ongoing conflict, the S&P 500 is down less than 4% year-to-date, highlighting how U.S. indices have absorbed successive shocks. Historical analysis, suggesting that equity markets often bottom early in major wars, is reinforcing the sense that much of the downside from the conflict may already be priced in. Market participants also point to wartime fiscal spending as a counterweight to the drag from higher gasoline prices. Positioning indicators add nuance to that resilience. Recent shifts in both systematic and discretionary strategies now flag a contrarian buy signal, implying that de-risking has gone far enough to reduce immediate downside pressure. At the same time, options markets show investors selling upside calls and adding hedges, and surveys report higher bearishness without large outflows or panic selling. Flows into diversified ETFs rather than single stock bets suggest a desire to stay invested while reducing concentration risk. Under the index level, however, breadth is poor. Nearly half of listed stocks trade at least 20% below their one-year highs, and materials and consumer names that led earlier in the year are now underperforming amid conflict-related uncertainty. Energy equities, despite recent strength, remain underowned in benchmarks, and valuations across the S&P 500 sit around 19 times forward earnings, leaving limited room for disappointment. This mix of resilient headlines and hidden weakness reinforces a two-sided risk profile, where dips continue to find buyers, but any negative surprise on inflation or geopolitics could trigger another round of de-risking. The most important bearish force remains the persistent Middle East energy shock. The closure and partial reopening of the Strait of Hormuz are severely restricting global crude flows, with Iran selectively allowing transit and effectively using tolls and exemptions to keep prices elevated. Even with some safe passage agreements, shipping volumes through the strait remain well below pre-conflict levels, and U.S. shale producers are not stepping up output, constrained by capital discipline and depleted top-tier drilling inventory. OPEC Plus efforts to raise production cannot fully offset export bottlenecks. Oil prices have already surged, with Brent moving from around $60 to above $100, and futures markets sitting in extreme backwardation as near-term barrels command a steep premium. Rapid inventory drawdowns suggest that even a sudden ceasefire would leave a supply hole that could take months to refill. The shock is radiating outward. Higher crude costs are lifting gasoline and diesel prices worldwide, pushing U.S. pump prices above $4 per gallon and feeding into global inflation through more expensive chemicals, plastics, fertilizers, and freight. Infrastructure damage adds a structural layer to the problem. Strikes on key petrochemical facilities and gas infrastructure in the Gulf, including sites in Qatar and Iran, could take years to fully repair, implying prolonged pressure on natural gas, sulfur, and helium supplies that are crucial for agriculture and semiconductors. While talk of ceasefires can trigger short-term pullbacks in energy equities, multiple commentaries argue that markets still underprice the risk that freedom of navigation through Hormuz remains impaired and that a durable supply response is slow. That underappreciated tail risk is a central reason why many investors remain cautious on global growth-sensitive assets. Rising inflation and higher yields are the second major headwind for risk assets. Headline U.S. CPI for March is expected to jump by around 1 to 1.5%, the largest monthly increase since 2022, driven largely by a roughly 20% rise in gasoline prices. Core PCE inflation for February is also tracking at about 0.4%, signaling sticky underlying price pressures even before the full impact of the latest commodity shock. Several commentators see the risk of inflation reaccelerating in the second half of the year as the primary threat to U.S. equities. Bond markets are reacting. The 10-year Treasury yield has already broken above 4.2%, with some highlighting 4.5% as a danger zone for risk assets and 4.75% as the next technical resistance. Long-term yields could face further upward pressure if both labor-driven and commodity-driven inflation persist, reinforcing a higher-for-longer policy stance and limiting scope for the Federal Reserve to cut rates quickly. At the same time, sizable U.S. fiscal deficits and concerns about future stimulus are eroding the traditional safe haven appeal of duration. This environment has several implications. With bond-equity correlations turning sharply positive, Treasuries are providing less diversification just as inflation uncertainty rises, pushing some investors toward cash, short maturity instruments, or real assets for stability. The U.S. dollar has reasserted itself as the dominant haven as rate cut expectations fade, while rate-sensitive and long-duration assets face valuation pressure. Looking ahead, upcoming CPI and PCE releases, along with Federal Reserve commentary that hints at either renewed tightening or extended pauses, are likely to be key catalysts for shifts in cross-asset risk appetite. Equity valuation and breadth risks round out the bearish drivers. Major indices such as the S&P 500 trade around 19 times forward earnings, a level that leaves limited room for disappointment when oil is above $100 and inflation is reaccelerating. Despite that, broad indices have only seen modest declines, masking the fact that almost half of listed stocks sit at least 20% below their one-year highs, with particular pain in materials and consumer segments exposed to higher energy and freight costs. Flows and positioning underscore this divergence. March saw outflows from technology and profit-taking in outperforming energy names, alongside inflows into cyclical areas like industrials and financials, as investors rotated exposure rather than exiting equities outright. Options markets show traders selling index upside and adding hedges, reflecting skepticism about further near-term gains. Technical indicators still describe the S&P 500 as being in a corrective phase, with momentum deleveraging by hedge funds and retail contributing to bouts of volatility. On the other hand, high-yield spreads remain contained and earnings estimates, especially for AI-linked and quality franchises, continue to edge higher, supporting the idea that the weakness is rotational rather than systemic. A definitive peace agreement in the Middle East, or a clear turn lower in inflation data, could quickly improve the risk-reward for equities at current multiples. Until then, elevated valuations and poor breadth act as amplifiers for any negative macro or geopolitical surprise. To sum up, today's risk backdrop is a fragile version of risk-on. Resilient AI-driven earnings and remarkably strong capital markets are keeping the equity and credit engines running, but they're pushing against a persistent Middle East energy shock, rising inflation and yields, and stretched valuations with narrow breadth. The balance of risks remains finely poised and highly dependent on incoming inflation data and developments around the Strait of Hormuz. Watching how credit spreads, long-end yields, and energy prices trade around those catalysts will be critical for understanding whether this cautious risk appetite can endure. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.